With a looming recession, it is never a bad idea to look at investing in more blue chip stocks. Today, we will look at 7 blue chip dividend stocks that you can hold forever. If you stick around until the end, I also have a bonus stock you may want to add to your watch list. We will begin right now. The stocks I have for you today have a minimum yield of 2%, a markup cap of at least $1 billion, and a history of weathering recessions. For this list, I am only looking at individual stocks, so we do not have any ETFs, income funds, or split core stocks. These are just good old blue chip stocks. Before we jump into the stocks, I have a request for you. If you love making money like I do, hit the subscribe button so you don't miss out on any financial content. And at the same time, you become a part of one of the greatest communities on YouTube. Okay, without any further ado, let's jump into those stocks. Kicking off our list is Canadian National Railway with a ticker of CNR. This is a stock I absolutely love, and full disclosure, it has a solid home in my portfolio. The Canadian National Railway is recession-proof and may very well be the most stable stock on this list today. As part of our supply chain and the most cost-effective way to move goods, they will never be out of demand, and this makes me smile as an investor. They have a market cap of $101.2 billion and a beta of 0.70, indicating they are a lot less volatile than the average market. Their earnings per share is 6.84, and they have a PE ratio of 21.50. Their dividend yield is 2%, which is paid out quarterly in the amount of 73.3 cents per share. When it comes to their return on investment, in the last year, their ROI is 12.9%, and that makes a total return of 14.9%. This is a stock well in the green in my portfolio, and that is why it kicked off this list. In our sixth spot, we are looking at Fortis with a ticker of FTS. This is a fantastic energy sector play. They are very solid with good diversification, including renewables. They are a dividend aristocrat that will be Canada's second dividend king within a year. Not too shabby. There is no way they will jeopardize that title, so you can be assured that their dividend is super safe. They have a market cap of $28.5 billion and a beta of 0.11, indicating they are big time less volatile than the average market. Their earnings per share is 2.60, and they have a PE ratio of 23.0. Their dividend yield is 3.58%, which is paid out quarterly in the amount of 53.5 cents per share. When it comes to their return on investment, in the last year their ROI is 9.5%, and that makes a total return of 13.1%. This is a stock that is also well in the green in my portfolio and definitely belongs in this list. In our fifth spot, we are looking at Canadian Utilities with a ticker of CU. This is another great energy sector play. They are Canada's only dividend king, meaning they have raised their dividend without missing a beat for 50 years in a row. Holy banana bread. They have a market cap of $7.4 billion and a beta of 0.57, once again indicating they are less volatile than the market. Their earnings per share is 1.53, and they have a PE ratio of 24.60. Their dividend yield is 4.713%, which is paid out quarterly in the amount of 44.4 cents per share. When it comes to their return on investment, in the last year, their ROI is 9.2%, and that makes a total return of 13.9%. Another great stock that is doing very well. In our fourth spot, we are looking at Manulife Financial with a ticker of MFC. They are a life insurance and wealth management company, and they are one of Canada's big 3 life insurance companies. They are also operating in the US as well as Asia, so we do have a very solid foundation for this blue chipper. They have a market cap of $42.1 billion and a beta of 1.20. This indicates, of course, that they are actually a little more volatile than the market average. Their earnings per share is 4.68, and they have a PE ratio of 4.70. Their dividend yield is 6.022%, which is paid out quarterly in the amount of 33 cents per share. When it comes to their return on investment, in the last year, their ROI is negative 11.9%, and that makes a total return of negative 5.88%. They have fallen just like the rest of the market, so you have to take their negative returns with a grain of salt. MFC is also not really a growth stock. They are a stable dividend play for the most part. Despite those negative returns, still a good long-term play and a part of my portfolio as well. In our third spot, we are looking at Enbridge with a ticker of ENB. This is the last energy sector play for today. They are a cornerstone of the Canadian energy sector, and despite the boom in energy, they are one company that many consider to be undervalued. I love this stock, and they do have a home in my portfolio. They have a market cap of $109.1 billion and a beta of 0.91, indicating they are less volatile than the market average. Their earnings per share is 2.88, and they have a PE ratio of 18.70. Their dividend yield is 6.388%, which is paid out quarterly in the amount of 86 cents per share. When it comes to their return on investment, in the last year, their ROI is 9.7%, and that makes a total return of 16.1%. Once again, another overall green superstar stock in my portfolio. In our second spot, we are looking at Northwest Health Properties Real Estate Investment Trust with a ticker of NWH.UN. This is the only REIT in our list, and they are a big player when it comes to healthcare real estate in Canada, Germany, Brazil, and Australia. They have a market cap of $2.9 billion and a beta of 0.79, once again indicating they are less volatile than the market average. Their earnings per share is 2.07, and they have a PE ratio of 5.90. Their dividend yield is 6.515%, which is paid out monthly in the amount of 6.7 cents per share. And this is the only monthly payer we have on the list today. When it comes to their return on investment, in the last year, their ROI is negative 7.0%, and that makes a total return of negative 0.5%. This is really not a huge growth stock, but they do tend to have a fairly good drift towards the upside. The negatives that we see today are merely a result of the overall market slump we are in. Despite that, this is a very good long-term hold. For our top pick, we are looking at one of the Canadian top 6 banks, and it is the Canadian Imperial Bank of Commerce with a ticker of CM. Honestly, any of the big 6 are good investments for the stability the banking sector has brought. They have a market cap of $57.1 billion and a beta of 1, indicating they are exactly just as volatile as the market average. Their earnings per share is 7.08, and they have a PE ratio of 8.90. Their dividend yield is 10.182%, which is paid out quarterly in the amount of 83 cents per share. When it comes to their return on investment, in the last year, their ROI is negative 11.7%, and that makes a total return of negative 1.5%. This looks bad, sure. However, the banks just got hit pretty bad, and CM lost 31.4% off of their all-time high back in March. They are on the rebound, and even with a recession, they will be fine if you hold them for the long term. Now, their dividend was also recently raised, indicating the company certainly has a lot of faith in themselves. Part of their downturn in price was also due to them acquiring Costco's Canadian credit card portfolio. CIBC is a very solid choice, and that is why they took the top spot today. At the top of the video, I mentioned a bonus stock for your watch list. Well, in a bid to beat the competition board, Rogers & Shaw have sold Mobile Freedom to Quebecor for $2.85 billion, and this makes Quebecor Canada's 4th wireless phone provider. So, let's take a peek at them. Quebecor has a ticket of QBR.A. Before this deal, they were the leading telecom provider in Quebec, and technically still are. Freedom takes them to the national stage. There are still some issues in that Freedom is not available everywhere, but they are more or less available in most of Canada's bigger cities. Quebecor has a market cap of $2.2 billion and a beta of 0.33, indicating they are a lot less volatile than the market average. Their earnings per share is 2.40, and they have a PE ratio of 12.70. Their dividend yield is 4.203%, which is paid out quarterly in the amount of 30 cents per share. When it comes to their return on investment, in the last year, their ROI is negative 14.5%, and that makes a total return of negative 10.3%. I think this is a stock you need to be patient with, as I don't see them growing too fast. If you are long-term and like their dividend yield, I think they have a chance to prove themselves. However, they are not blue chip, and if you are looking for a more stable play within the communication sector, any of the big three, Bell, Telus, or Rogers, would be a safer bet. Speaking of safe bets, you should check out my video on CN, or you can try the video YouTube thinks you will like more. You can decide who's right, and I'll see you in the next video.